Would you be surprised if I was to tell you that there is a simple do-it-yourself investment strategy that even a second grader can understand, would only take 15 minutes of time a year, outperform the majority of actively managed funds in the long run, and will eventually turn you into a millionaire? Well, believe it or not, it's true, and it's called the 3-fund portfolio. And if you were to follow this simple recipe throughout your investing journey, you'll almost surely not only beat out the majority of stock-picking investors out there, but even the most professional investors. Hi, if you're new to the channel, my name is Tay from Financial Tortoise. In this channel, I make videos about personal finance, investing, and all the while surviving in a multi-generational family. If this sounds interesting to you, consider subscribing as well as hitting that like button. And if you have yet to download your free copy of the Standard Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future, please go to my website at financialtortoise.com and do so. I send out weekly newsletters with other great tips on mastering your money, and I wouldn't want you to miss them. In this video, we're going to deep dive into one of the most popular do-it-yourself investment strategies, the 3-fund portfolio strategy. I'll show what it essentially is, what makes this strategy so successful, as well as a list of funds necessary to create the portfolio for yourself. The 3-fund portfolio, as its name implies, is made up of 3 simple funds. 1, a total US stock market index. This fund essentially holds every single stocks in the US stock market. At the time of this video, there are approximately 4,000 of these publicly traded companies. Think of popular stocks like Apple, Google, and Amazon, as well as some lesser known ones like Dollar Tree or M&T Bank. 2, a total international stock index fund. This fund would include all the stocks from the rest of the world, excluding the ones headquartered in the United States. At the time of this video, there are close to 8,000 of these stocks. And they would include some companies that you might have heard of, like Samsung or Shell, and many you didn't even know existed. The 3rd fund of this trifecta is a total US bond market index fund. This fund would include all types of bonds you could think of, varying credit quality ratings from US government to BBB, and varying maturities from short-term to long-term. At the time of this video, there are more than 10,000 bonds within this fund. And like a good cake, when you mix these 3 into a single portfolio, you get the ultimate DIY 3-fund portfolio. Now, one trend you might have noticed at this point is that all these funds are a variation of a total market index fund, index of the market that they're indexing. You might be asking, why am I only seeing the index here? How about some of the sexy stocks I hear in the news? Well, that's where buying index funds is really amazing, because when you buy index fund, you're getting a piece of all those sexy stocks you constantly hear about on the news. When you purchase these 3 total market index funds, you have your money invested in literally every single stocks and bonds traded in the world. Combined, over 20,000 stocks and bonds in total. You essentially have your money invested all around the world. And another nice benefit of these 3 funds is that there is no overlap between them. The total stock market index is only buying US-based stocks. The total international index is buying up all the non-US based stocks. And the total bond index is purchasing all the high-quality bonds out there. Why try to pick the hot winning stocks when you can essentially buy them all, right? Alright, let's jump into more specifically some key benefits of this 3-fund portfolio. Number 1 is that this strategy, as I alluded earlier, mitigates individual stock risks. Many investors, especially those that are just getting started in the market, are constantly trying to beat the market. And they do this by trying to identify winning individual stocks. Just Google hot stocks for today, and you get an endless list of recommendations, all touting how their recommendation will get you amazing returns if you just follow them. What's often unspoken is regarding many of their bad picks. Stock pickers love talking about their lucky picks, but like anything else in life, they rarely reveal their worst picks. Let's not forget that many of these stocks that were once on the buy now list have many times turned into complete losers. Do you guys remember Blockbusters, Sears, or Kodak? Stock picking is a futile game, and it's almost impossible to pick tomorrow's winners, just as it is impossible to predict many black swan events. The 3-fund portfolio completely bypasses this individual stock risk because its foundation is based on low-cost total market index funds, not stock picking. Another benefit to the 3-fund portfolio strategy is that it completely cuts out financial advisors, or sometimes called investment managers or fund managers. Who knows these days, right? Their names change constantly to throw off individual investors, and soon they might be called fund concierge. I have a whole video on why I don't like investment managers here, but in a nutshell, when you're working with a fund manager, you have to deal with their inherent conflict of interest. What do I mean by this? Investing can feel daunting and complex. so many people opt to work with a professional. But oftentimes what happens when you hand over your money to these so-called professionals is that they aren't incentivized to get you good returns. Rather, they're just incentivized to either sell you more financial products that you don't need or manage as much of your money as possible. And this is because this is how they make their money. Think about this. With your money, you want the best returns at the lowest cost. Your advisor actually wants the opposite, the highest cost, and who cares about the returns? They just need something to have you believe that they're doing their job. And what's worse is that a lot of these advisor fees are hard to identify and hidden in the crevices of your fund. It's not rare to see brokers and advisors making more money than their customers. And what's criminal is that it was the customer's money to begin with. Bypass this criminality by using the simple 3-fund portfolio strategy to manage your money. You'll keep more money in your pocket and out of the pockets of those that want a piece of your pie. Another crucial benefit to the 3-fund portfolio strategy is its exceptional low cost. Most of us have learned with life experience that cheap may not always be the best. I mean, just visit your local 99-cent store. Few of the items there might be useful, but most of them are 99 cents for a reason. So for many things in life, paying more will often get us better service and better quality. Thus, it's not a surprise that many investors believe paying for more expensive funds and more expensive investments will lead to better returns. Ironically, when it comes to investing in the stock market, the opposite is true. Study after study have proven that high-cost, actively managed funds don't fare much better than passive index funds. So by investing in a simple 3-fund portfolio of total market index funds, you essentially eliminate the costs associated with high-cost funds and high-cost fund managers and put more money in your pocket versus theirs. And fund costs are crucial to your ultimate portfolio returns. To give you an example of the impact of the cost, imagine if, let's say, stocks gained an average of 6% annually for the next 30 years. If you invested $250,000 with a 1% annual fee to a fund manager, you're giving away more than $350,000 in gains because of the fee. What's crazy is that this is more than the original investment of $250,000. I don't know about you, but I'd rather keep that $350,000 in my personal portfolio rather than funding someone else's pocket. And when you invest in a 3-fund portfolio, you're getting rock bottom costs when it comes to their expense ratios. But my favorite benefit to this 3-fund strategy is that it is just so simple. Jack Bogle likes to say, simplicity is the master key to financial success. Jill Collins, one of my favorite authors, has a book titled The Simple Path to Wealth. Financial industry tries to convince us that investing is so complicated that we must buy their expensive products and services if we want to be successful investors. Well, that is just a lie. In 2020, it was recorded that there were close to 8,000 mutual funds in the market. What this means is that there are more mutual funds than the actual number of publicly traded companies in the market. There is more packaging of these companies into different types of mutual funds than the goods themselves. To me, this shows that there is no shortage of financial investment companies creating new financial products and working hard to entice novice investors to buy their sure-winning funds. The simple 3-fund portfolio contains more stocks and more bonds than pretty much all these mutual funds out there, and at lower cost and better diversification. They're simple to understand and maintain, and unlike what the media likes us to believe, this investing strategy doesn't require complex mathematics, spreadsheets, and fancy financial advisors. Alright, enough me talking about why 3-fund portfolio is so amazing. Let's talk about how to build your own 3-fund portfolio. I'm going to talk specifically about Vanguard funds here since that's my investment firm of choice, but other major firms should have similar funds. Just make sure you check the expense ratio and the fund composition. For the total stock market index fund, I recommend Vanguard's VTSAX. An ETF equivalent is Vanguard Total Stock Market ETF, VTI. VTSAX has an expense ratio of 0.04% and a minimum investment of $3,000. For the Total International Stock Market Index Fund, I recommend Vanguard's VTIAX. An ETF equivalent is Vanguard Total International Stock ETF, VXUS. VTIAX has an expense ratio of 0.11% and the same minimum investment of $3,000. And for the Total Bond Index Fund, I recommend Vanguard's VBTLX. An ETF equivalent is Vanguard Total Bond Market ETF, BND. VBTLX has an expense ratio of 0.05%, and it too has a minimum investment requirement of $3,000. Now again, if for some reason you don't have access to these funds, similar alternatives are okay. For example, in my 401k, which is run by Fidelity, the closest fund I could find to a total stock market index fund was their S&P 500 fund. Now, am I bummed I couldn't get Vanguard's VTSAX? Maybe a little bit. But remember, compared to many people who are investing in actively managed funds and individual stocks, if you're able to even invest in total market index funds, you're way ahead of the game. All right, the next question you might be asking is, how much of each should I buy? This is what's called asset allocation in the finance world. What percentage of your total portfolio should you hold in total stock versus total international versus total bond index funds? And you want to think really hard about this one because based on your life stage, the allocation you decide will have a tremendous impact on your potential returns and ability to retire. A general rule of thumb you want to understand is the relationship between risk and reward and how it compares to stocks and bonds. If you want to take more risk with your portfolio, you want to hold more stocks. If you want to take less risk, then you want to hold more bonds. But when you take less risk, there are also less reward, meaning potential for high returns. Take a look at the chart here I borrowed from Boglehead's Guide to Investing. This chart shows maximum annual loss and the average annual return an investor would have incurred during the period from 1926 to 2012 based on various stock to bond allocation. If you were to have been 100% in stocks, though your average returns would have been the highest at 10%, at your worst year, your portfolio would have lost 43% of its value. Imagine you're about to retire and your portfolio just dipped by almost half its value. You either need to push back your retirement or have a heart attack. Maybe a combination of both. Now imagine that you're very risk averse, so you decide to go 100% bond. Okay, so you're protected from the worst annual loss to just 8%, but your average return is only 5.5%. So by being so risk averse, you missed out on much of the gains from the market return. So based on your life stage and risk tolerance, you will need to decide how much bond and stocks you feel most comfortable with. Are you the type that's okay with riding the high ups and downs of the market without letting your emotions get to you? The worst thing you want to do when the market is down is to sell. Actually, this is a time you want to be buying because the market will eventually recover and you want to take advantage of that ride up. But if you know yourself and don't want to expose yourself to that much emotional roller coaster, then you should consider having more bonds in your portfolio. A good reference point for the right allocation is take a look at some of the target date fund allocations. Vanguard's Target Retirement Fund, VLXVX, a fund that is for people in their 20s right now, recommends 10% in bonds. Another target date fund, VTHRX, which is for people who are 10 years from retirement, it recommends 35% in bonds. When it comes to how much to put towards an international index fund, there is no one right answer because even many index fund advocate experts debate this. Jill Collins believed that you don't really need international index funds because when you own VTSAX, you already have exposure to the international markets due to a good chunk of the revenue coming from the international market. Jack Bogle has stated that he's fine with people holding up to 20%. Vanguard Investments is actually the most aggressive of the bunch. They recommend at least 20% in international index funds. So if you aren't sure, 20% is a good place to start based on your worldview regarding international companies. And you can always taper this number up or down. One thing I want to emphasize after you come up with your asset allocation is that you want to rebalance at least once a year. You might be targeting a 80% to 20% stock versus bond allocation. But throughout the year, because maybe stock value increased or decreased, your actual allocation might be a little bit off. All you need to do is either buy more stocks or bonds the following year to bring you back to your ideal asset allocation. Don't be scared of managing your own investments. You are more than capable. I used to be terrified of all the complex looking investment products out there. So at one point in my life, I did have financial advisors making my investment decisions for me. But by educating myself, I gained the confidence to manage my own money and fired my financial advisor. If I, who've made all the money mistakes you can think of, can do it, I have complete confidence that you can as well. Use the 3-fund portfolio strategy as your framework and get working. Thank you guys for watching, and until next time, all the best.